You're betting that it's going to go up. But what I think about is where it potentially not going to go. So in the next 57 days, I'm saying the S&P 500 is not going to go to 45.75 within the next 57 days. And I'm not going to. So I'm going to go into I'm going to use the ES to break down what we call a bread and butter bull put spread. It's also called a vertical put spread, a short vertical put spread. So it's the names are the same. This sounds a little different, but they all mean the same thing. A short put spread means you're selling it. A bull put spread means you're selling it. A short vertical put spread means you're selling it. Right? All those terms are the same. And so what I've been trying to do recently, at least over the last several months, is call it the bull put spread. So people who are new understand that it's a bullish strategy when you're selling the put spread. So if I go over here to this ES here and I look for a time frame, what we consider here at the Dorian Trader our bread and butter swing time frame, that is 30 to 60 days. And so in this example here, I'm looking at these expiration periods, 40 to 58 here, and you can choose any of these. I'm usually trying to go closer to the 60 days, but that doesn't mean you can't use the 40 in this example. But I'm going to use the 57 here and go out to this 57. And then once we open up the option chain, when we're doing a bullish put spread that we teach in lesson 3, this is the first strategy we teach in course 1, lesson 3, because this right here is my favorite strategy. It's, to me, the easiest strategy to execute besides doing just a single leg put that you sell. This is a basic type of option trade that's not associating shares with it. You're not trying to take shares or own shares or have the potential to own shares. You're not trying to do that with the put spread. You're trying to just speculate that the stock is going to go up, or better yet, it's not going to go down to the point of your short strike on the put spread that you're selling. So for example purposes, when we're doing this at the Dorian Trader, we try to do no higher than a 15 delta to initiate the trade. So no higher than a 15 delta. And if we're using the ES, no wider than 100 points wide. If we're using options on stock, no wider than 20 points wide. That is considered a standard trade for us. Can you go wider on the ES? Yes. Can you go wider on a stock? Yes. But it wouldn't be considered standard for us. Doesn't mean you can't do it. We just call those non-standard trades. And sometimes the non-standard trade might fit your portfolio better. Or maybe a lot of times it does. But for us at the Dorian Trader, this is a standard put spread. This is the type of put spread I ran in my hedge fund for a decade. So I'm going to go here, and I just say I'm going to go down to the 7 delta. I go down to the 7 delta, and I just go to this 45.75. That's currently a 7 delta. If I was going to do a 100-point wide, I would go to the 44.75, and this would be the max spread I would do. The most you can lose on this spread is $5,000 on the ES, because the denominator for the ES is 50 points, or excuse me, $50 per point. On options on stock, it's all uniform, it's all standard. The denominator is $100 per point. On options on futures, you have to know the denominator. And so on the ES, it's $50 a point. That's the only real difference that you have to kind of understand and remember, is that the denominator on the ES is half the size of the SPX. Still the same underlining, still all the same things, except one is smaller. It's half the size. So in this example here, this is not going to be 365 that we're receiving. It's actually half of that, so it's going to be 183. And the most we can make is that 183. It's jumping around right now because the market's open. And then our max loss is going to be that 5,000 minus the credit we received. So that's why it's saying right here 58.25. And then this is the buying power that is required. So you guys know at the Dorian Trader, we want to receive a certain percentage on our buying power when we're doing the trade. So we have a certain delta range that we want to do. We have a certain width we want to do. We have a certain buying return on the buying power we want to do. We have a certain dollar amount we want to collect. We talk about all of this in course 1, lesson 3. So if I was going to do this trade here, I would be collecting 175, what it's showing right now. That's going to be over, if I divide it by this buying power here, this 854. I don't care about the cents. So 175 divided by 854, that's going to be 20% return on capital. So that's not bad. That's awesome. 20% return on capital. But what is more impressive, well, that's impressive. I can't say more impressive. What's also impressive is how far we're away from at the money. So we just do the percentage calculation. We take the short strike minus the last price divided by the last price. That's going to give us a percentage of how far we're away from the last price, the at the money. So 45.75 minus 51.13 divided by 51.13. So that's 10.5% away. 10.5% away. That is more than a correction away from where where the ES is currently trading at. So to me, that is awesome. You're double digits away from where it's currently trading. So the market could go up and you'll win 100% of the time. The market can go down, and as TastyTrade is saying here, you're going to win. They're saying 97% of the time. You're still going to win something at expiration. It's instead of 90, it's really like 93% of the time if you go by this delta here, right? You take a 100 minus 7, and that's going to be 93. So you got a 93% chance at least of making at something at expiration. So what makes this trade so dynamic and awesome for me, and my favorite strategy, if I only had to pick one, it would be this strategy, because I do not have to be right directionally to still win. And you guys know, if you've been around for a long time, I'm right at best 50%, maybe sometime a little bit more than that. But if we keep doing it, law of large numbers, I'm only going to be right 50% of the time on a directional move at best. But if I structure my trades in such a strategic way, I could still be right 90+% of the time, even when I'm wrong directionally. Because if you do a bull put spread, this bullish put spread here, selling of a put spread, you are bullish. You're betting that it's going to go up. But what I think about is where it potentially not going to go. So in the next 57 days, I'm saying the S&P 500 is not going to go to 45.75 within the next 57 days. And I'm not going to try to stay in this for 57 days. As you guys know, I'm going to take my profits at 50 to 75%. And I'm not just going to wait until it's breached or it's touched. I'm going to adjust it if it does become a problem, to try to enhance my odds. But most of the time with this trade, it's not going to become a problem. It's not going to become a problem. So this is what I wanted to introduce regarding the put spread.